Oh boy.
I just get to say what the SEC might
Does this feel like coffee? This is really uncomfortable.
Hey, I appreciate you all coming, and I think we have a fairly exciting list for our last program of the season. There will be, for those of you who are into this kind of stuff, here comes Big John Fetters. There will be a mixer on Tuesday, is that the 3rd? Hi, John. Down at Bobby Van's at 6 o'clock. Somebody want to correct me on this? I might be from the and alumni, students, and Chris is going to come back into town.
Oh yeah, definitely. Yeah. Looking forward to it.
All righty. The program is on high-frequency trading. Let me get over the anxious part, which is using the speakers without putting my foot in my mouth, which you all know for me is very difficult. And then I'll talk a little bit about why we're putting on this program today, and then I'll try to be quiet and let people who are a lot smarter than I am, even though they were once students of mine, at least two of them, speak. Immediately to my right is Jamie Brigliano. Jamie's with Sidley and Austin. He had been the deputy director of trading and market. I do it most of the time in market regulation at the SEC. And he went to that other Catholic law school here in town, which we don't need to mention in these small ways. Chris Contanin, to Jamie's right, is something significant with Virtue Financial, and prior to that, he with Instinet, and prior to that, he was the executive vice president of NASDAQ up in New York, and prior to that, I don't know, he ruled a small third world country in Africa. And for those of you who look to me for advice, I always like to bring this up. Chris, when he was in law school, wrote and advocated a topic, and I think you wrote a paper on it, I know you did, corrective research or something, on order pay for trade. And I said to him repeatedly, this will get you nowhere, this is too basic, you're not looking at it sophisticated enough. It is one of the basic rules of the national market system now. Just do disclosure, that's what we need to do. So, and off to Chris's right is T.R. Lazo, Theodore, who is the General Counsel of Regulation in NYSC. Prior to that, Morgan Lewis. Prior to that is at the SEC. And as we were discussing before, it was at T.R.'s house where we used to have our Christmas and graduation parties every year. It's on festive in my law firm, Wisconsin. And I go by there, and every time I go by there, it just a lot of nostalgia comes freaking out. I used to have my kids on my shoulders walking around. I'm very short, not getting extra height. DR mentioned that it burnt down from the inside recently, which is a good thing for it to do if you want to kind of stand as a monument. All right, well, that's the introductions. High frequency trading. I was in Lisbon. Have you been in Lisbon, Chris?
No, not yet.
No,
yeah.
I was in Lisbon. Yeah, I was giving a talk in Lisbon.
Does it have anything to do with TR's fire in this house? Are we going to get back on topic?
Yeah, soon. And I wanted to, and I spoke about trading. I wanted to give the title of the talk as follows: a strange thing happened on the way to the national market system. But I figured nobody in Portugal would understand that because they didn't see the play, so I thought I'd give that here, and then I realized except for John, we're all too young to know that there was a play. A strange thing happened on Lloyd Forum. And the reason I say that that would be a good topic is that back in the good old days, post-1975, there was legislation that came down called the Security Reform Act of 1975, conveniently named, which proposed the establishment of something called the National Market System. And in order to achieve this goal, you had to implement transaction reporting systems, quote systems, the ability to get to other markets, efficient execution systems, the ability to get best trade, all that stuff. And, you know, during my 1 year, 10 months, 23 days at Market Regulation, we worked on this. And some of these things came into place. And by maybe the mid-'80s, late '80s, it was beginning to be recognizable that something was happening. There was a new type of system. And then these creations called electronic communication networks came along, and then there were trade rules, order handling rules that made the ECNs a little bit more popular. And so by about the year 2000, we had achieved for everyone to see something in my mind that looked a heck of a lot like this national market system that people envisioned back in 1975. And in terms of Washington time, that wasn't too bad. And something happened between 2000 and now, and it was there already. It was brewing, it was percolating, you know, it was bubbling up. There was this prehistoric creature that had been radiated by atomic explosion. And it was, some people called it program trading, computerized trading. And somewhere, I don't know, in the past 5, 6, 7 years, got this moniker, high-frequency trading. And it's sort of, TR a year ago wanted to put this program on for one reason or another. We were delayed, and I think that it was fortuitous because we put this program together, and then another few saw the Journal on Thursday last week said, SEC is going to be investigating high-frequency trading. And then on Friday, we discovered that all of us who have put our fortune into apples had lost 10% of the value because of high-frequency trading. So somewhere along the line, and the fascinating thing, when you hear the speeches of the chair lady of the SEC, and she says, this is our most severe regulatory problem. And you look at the market crash, May 6, 2010, all this is high-frequency trading. And in my mind, though, this TR and maybe Jamie will argue otherwise, in my mind, we haven't really figured out how to control high-frequency trading. Is it good, is it bad? It's creating new kinds of tighter spreads and lots of liquidity. But the interesting thing about it is that it's all based on numbers. And here we have this whole disclosure system that's based upon the underlying value of security. And now all that is for somewhere between 50 to 70% of our trading. Really doesn't matter because they're not looking to the underlying value. They're looking to slight little algorithmic changes in pricing. So we're going to lay out a little bit of what high-frequency trading is, and that's going to be Chris's job. And then Jamie's going to be talking about some of the regulatory issues, and TR, who is with, again, the New York Stock Exchange, is going to tell us all how it gets to be fixed. And with that, I will sit down and be quiet. I thank you all again for coming here. There will be a reception afterwards. Think about coming, particularly you young folk, hi John, think about coming to the mixer next Tuesday. I'll turn it over to Chris. Thank you. You are scheduled.
Okay, yeah, I am first. So,
with that introduction.
yeah, that was great. That was very brief and very helpful. So, high-frequency trading, you know, the funny thing is no one really knows what it is. We all like to talk about it. We all like to say it exists. We all like to identify it and say it's the cause of different issues in the market. But no one's been able to, and there's regulators around the globe that are struggling with the same issue. What is high-frequency trading? And a lot of people in the industry are saying, well, it encompasses a lot of different trading activity that exists in the market. And you can't just wrap it in a bow and say, this is exactly high-frequency trading. And then there's people who are saying, well, what are we trying to define? We've never really defined trading strategies or trading behaviors. We've tried to surveil for it, inspect for it, and regulate it. And we don't have to actually define it because it's constantly moving and evolving. So that's the ongoing debate in the industry is what is high-frequency trading? Can we define it? Can we identify it? And then if we do, what do we do with that? Right? What's the next step? Do we put a box around it? Do we regulate it? Do we register it? These are all the things that regulators use when they have a concern, either a political concern that they have to solve or some other concern that's raised. High-frequency trading, from my vantage point, is a trading strategy. It doesn't sit in any one form of a legal entity. It can be in a hedge fund. It can be in an investment bank. It can be in a proprietary firm. My firm would be labeled in any definition as a high-frequency trading firm. We trade a lot, we trade frequently, and we use computers on every trade. There are no humans pressing buttons, placing an order. In the market, if you want to engage this market as a professional, you're likely not pressing a button. You're likely not picking up the phone and calling in a trade. Even retail investors are clicking on a website that is executing an order in a matter of seconds with an execution report coming back. Those are things that didn't exist when we had manual trading, where you actually had a human in a pit that looked at every order and decided whether or not that order should be executed at that moment in time and whether it should be executed against his book or another order in the book. So when you had humans in the market deciding market flows, that was the complaint. I mean, we had Reg NMS in 2005, really the driving behind that so-called regulation that just said everything has to be automated if you want to be a protected quote, a quote that's respected by everybody else in the industry. You can't be human. You can't have a human reaction. And the reason why the SEC was driving that rule through was because of the concerns around the human specialist at the floor, human traders on the other end of the phone on NASDAQ, people who had an advantage by slowing down the market. They had an informational and time advantage. And so we all of us, some of us were at the SEC, some of us were outside the SEC, said, let's go to the automated market. Let's make everything automated. Every quote you see, every market you touch is automated. So the full market, and it has been for a while, is fully automated. There's every order that gets executed, every print that you see on Yahoo is from a computer. It's a computer making the trade, actually executing it at an exchange, or it's a computer that sent the order. So we have a fully automated, fully electronic market, and no one disputes that fact. Now, how do you have participants engage that market? So market makers, people engage the market professionally every day, trading every security under the sun. They cannot engage that market on a manual basis. Right? My firm is a market maker in over 1,000 names in the U.S. We trade on 196 markets around the globe, and we have 132 people in the firm. So we use computers everywhere. If you want to engage the market globally, whether it's cash equities in the U.S., in Europe, in Asia, futures anywhere around the globe, FX, it's all electronic. So if you want to be a dealer in that market, you want to be a professional in that market, you actually have to do it through a computer. You cannot trade on a bid and an offer with a spread that's less than a penny all day long unless you're using a computer, unless you're using an application sitting in a data center somewhere. Now, you wonder about our use of a computer. Well, is that fair? Can other people use computers? Well, they do. The average institutional investor trades through the use of an algorithm, which is actually a computer sitting in a data center that says, I have 1 million shares that I want to buy, and I'm going to execute it over the course of this period based on my algorithm's decision of when to enter the market and when not to enter the market. So it's smart order algorithms have been around for over 10 years, more sophisticated in the last 5 years. What they're doing is they're replacing a human trader that would otherwise make those gut calls sitting on a desk, calling out to people trying to understand where the market is in a stock. That was all converted to a computer, an application sitting in a data center. And that's how the world actually trades. So if you're holding a mutual fund anywhere, and typically law students don't hold mutual funds because they're broke anyway, your mutual fund is investing through what my view is high-frequency trading. So you're all high-frequency traders if you're holding mutual funds. The reason why it's high-frequency trading, it's an algorithm, it's a computer application, it's sitting in a data center making computer-based decisions. And the only difference between what they do and what I do is we buy on the bid and sell on the offer. This algorithm buys on the bid or sells on the offer. So very similar, but one position, one direction. And so you look at the world and you say it's fairly automated. The professionals that have to sit in the middle as dealers can't possibly be human. They have to be automated. So by definition, you're a high-frequency trader. So you're left with the question, okay, who else is a high-frequency trader? Well, hedge funds have grown to be high-frequency traders. They have a position that they want to engage, a long or short. They want to be long. They want to be short the stock. They may want to be that direction for a second, a minute, an hour a day, a month. It depends. Renaissance, one of the largest, most successful hedge funds sitting on Long Island in New York, is an HFT, high-frequency trader. They make positional, directional decisions based on an algorithm, trends in the market that can be a second, can be a minute, 2 minutes, 5, you name it. And then they have algorithms that decide to invest over a week or a month. And it's all done based on computers. So there are high-frequency traders, so to speak, in all different forms of the market. And the question is, now that everyone's automated and everyone's electronic, how do we surveil it? How do we regulate it? Are there these powerful tools that can abuse the market? And I think that's really ultimately where the regulation has to go is we have all these new forms of traders. They're no longer a human sitting on a floor or on the other end of the phone. They're an application running in a data center. And how do we surveil that trader, that new automated trader, is not impacting the market in an inappropriate manner, not creating volatility, not creating inefficiencies in the market? And that's the hardest job of the regulator. And that's really the challenge, and why the regulators are talking about surveillance and a consolidated audit trail and all these things we thought we had. And so that's really the challenge that I see this market has when it comes. It's not really, do we need to identify everyone, because pretty much everyone will be caught into that basket. And if you make it narrow, the basket will evolve and move around, and you'll be trying to target the same thing you tried to target. At the end of the day, we have new forms of traders. They're called computer bots sitting in a data center somewhere, and we have to figure out how to regulate them like we've never regulated before. So new forms of surveillance that look at microseconds, not seconds. New forms of obligations on certain market behaviors. If you're going to engage the market in a frequent and dealer-like capacity, you should have obligations that come with that, where you make a two-sided market, that you're there in the middle of a flash crash, you don't pull out and let the market collapse, things like that. And so those are the challenges that the regulators have. We've been talking about high-frequency trading for 3 years, yet no one has a solution. No one has well, we know what they are. They're these 5 things, and we know how to regulate them. And so that's why you continue to hear journalists don't like to talk about things that are not sexy or cool or controversial. So they continue to talk about these HFTs and how they manipulate the market and cause havoc and wreak havoc. And just the other day, this poor exchange, BATS, which is one of the best-known exchanges on the market in the last couple of years, and I competed against them when I was running NASDAQ, and it was painful to compete against them. They tried to go public. They had a system outage and in trading their own stock, and it turns out that their system didn't know how to recognize their own name as a symbol, and it puked and collapsed. And so I'm astonished that the stories being written are, well, this is just another example of high-frequency traders causing market problems. And this is a poor exchange who had a computer outage. It's not any high-frequency trader. And then you go back to the so-called flash crash of May 6th. Am I rambling like you?
No. This is the Chris Contamin that I knew it was. This is just fantastic.
Yeah.
It's old Toby.
So just because, Professor brought it up, the flash crash. The truth behind the flash crash is that there was a human trader sitting at an institutional buy-only fund that decided he was going to hedge his portfolio. And he placed an order to sell futures, E-mini futures, S&P E-mini futures, to the tune of $4.5 billion. That's how much he sold. And he had no price limit on his algorithm that he placed the order in. The trader, the actual trader who was supposed to submit the order, was out at lunch. The portfolio manager did not call him, placed the order himself, and the algorithm went off. Our firm was on the other side of that algorithm. It was selling in the E-minis at a time when the market had already collapsed because Europe had kind of fallen apart. The euro had collapsed in the face of all the other issues it was having. And this sell order went in at 2:30 in the afternoon. The size of the bid offer on the E-mini market was about a third of what it normally is on an average day. And he just continued to sell. It never stopped. The selling pressure just kept coming. $4 billion of E-mini is a lot. And the market consumed it, and it consumed it and sold equities as a hedge. And that's exactly what happened. And during that hedge, you had the NYSE go into its normal halt procedure, which is a normal circuit breaker. The rest of the market did not. NYSE ARCA started having challenges, and there was nothing left. There was no other pieces of liquidity left for all that sell pressure to sweep through the market, and the market collapsed, and in 2 minutes later, it was back to where it was. The selling was off, and that was the flash crash. And a lot of people kind of rewrite the history that there was high-frequency traders, and it was just a buy-only institutional fund that was hedging a portfolio. I'll end there.
One of the things, one of the reasons why this reminds me of the Chris that I knew and loved 17 years ago is that if you haven't gotten it yet, Chris is a flim-flam man. See, and what he's basically saying is, okay, so the HFTs, they're cannibals, they eat people. Basically, we are all cannibals and we all eat people. That's essentially Chris's argument. And how are we going to distinguish one cannibal from another? Did I get it right?
Yeah. I mean, actually, I would add that cannibalism is okay.
Yeah, sorry.
As long as you don't eat small people.
You've got to get your nutrition somewhere. Okay, so Jamie's task, he was tasked with the idea that he would look at the overview of the regulatory concerns and strategies, and maybe, only if you want to, Jamie, you could slip in there why there are good cannibals and bad cannibals. That might help sort of educate the audience, because otherwise they're going to go away believing Chris's argument that we're all the same cannibals.
Well, maybe we can talk about activities versus actors, and focusing instead of who's good and who's bad at particular activities. But thank you. I first want to thank you for inviting me. It's a beautiful law school, and a couple of weeks ago I had occasion to flip through the Catholic U Securities Law Alumni Directory, and it's daunting. I mean, it is just an array of people who have just done very significant things in both the private and public sectors. And I actually had a career at the SEC as a litigator before I joined then Market Reg, and I got to Market Reg. There were lots of alums. I was told immediately that Catholic U was the favorite law school of the division, by the way. So, but when I started working with folks, I could certainly see why. And Chris and TR and my partner Kevin Campion is one of the leading securities trading regulatory lawyers in the country, and Tom Ide, another friend of ours who's senior counsel at one of the major firms, perhaps a competitor of Chris's. But in any event, so yeah, so thanks for having me. So it's just we've just had the flash crash, and you know, the SEC as usual has to comment after the crash. But I would start with a very recent history. In 2010, the Commission did a market structure concept release, and you know, that's a document that it didn't propose a particular rule, but sought to really assess the quality of the markets for different, you know, for all the market participants, ask a lot of questions, and really discuss the current market structure and seek comment on, you know, people's concerns. It really is a good, in addition to Professor Lipton's materials and lectures, it's a great overview, I think, a readable overview of current market structure. And also, Chris talked about the flash crash. This is great to relive. He's exactly right. There's a flash crash report that's public that's not quite as easy to read as the market structure release, but also is a great, you know, kind of blow by blow of what happened, what regulators found, and you know, it's really worthwhile if you're interested.
We have Berman speaking here.
Greg Berman, your former colleague of mine, who's a great speaker.
He gave a fantastic job. It was fall of last year, I believe.
Yeah, he was our MIT guy.
Yes.
You know, the techie that helped us all. But anyway, so you know, part of the concept release discusses high frequency trading. And you know, as Chris said, without defining it, but highly automated trading, certainly over half the trades even in 2010. And the release noted the considerable benefits of all that trading in facilitating liquidity, you know, deep liquid markets, tight spreads. That means, what does that mean? It means that investors can buy and sell when they want to at the most efficient price, at the best price for them. And that's a key goal of market structure. And, you know, it links, it's not all just a trading game. There is a link to capital formation, because people will not invest if they can't get out, if they don't have an exit strategy. People have to be able to buy and sell for them to invest in the first place. So sound functioning markets are very important. And, you know, the reason the flash crash, since incidents like that are so important, is because it's extremely important that investors have confidence that markets will work well, or they won't put capital in them. So that's why the SEC, you know, and other regulators have to care so much. So, you know, acknowledging the benefits of highly automated, high frequency trading, you know, what possible concerns did the Commission raise and seek comment on? Well, one is that there could be manipulation, that somehow, you know, certain high-frequency traders might either jump in front of institutional orders and make their prices higher, or you know, or lower as the case may be, but a worse price, or even trade in a way that could move the markets in the direction that the HFT wanted them to go. The SEC didn't say this was happening, but it raised the issues of, are these things that are happening, and, you know, sought comment on that, and if they were happening, you know, what to do about it. Manipulation is, you know, viewed as very, very bad, and really destroys market confidence, so the SEC should be vigilant about it. There have been there was another inquiry reported publicly a week or so ago involving bats, where the regulators were looking to see whether there were any special arrangements that with trading on bats that could be manipulative. And I'm not suggesting for 1 minute that there were, but there was a headline about that, so regulators are going to look into that kind of thing. Another concern, and in a sense this may be, particularly as we've mentioned the flash crash, the most important one, and that's the concerns about destabilization. You know, is there going to be a huge order that blows through regulatory limits? Of course, that's not a high frequency, you know, frequent small trade matter, but just that someone in the markets, in the automated markets, can kind of input an order that will destabilize things. Will there be an error trade, an algo gone haywire? You know, a fat finger. Since things are highly automated and systematized, it's conceivable that if there is a glitch, it could have systemic ramifications. And the third concern that the SEC raised, and Chris touched on this as well, is, are these highly automated, high-tech traders, do they have some unfair advantage? They've got their computers next to the markets with co-location, and does that allow them to get ahead of everyone else and get better prices? And boy, that just doesn't sound fair. Of course, there are other sides to this in a sense. If you're buying 100 shares of IBM, probably a millicent, and it doesn't matter so much. But so traders need different things out of the markets. Cancellations are something that you hear about. Well, how can it be that people cancel 90% of their orders? Well, one reason it can be is that they're changing the price and size very frequently, and it just happens that the technology today can do it so fast and so often that it's a high cancellation rate. But firms will tell you that they succeed on executions. You have to make trades to make money and supply liquidity to make money. So there's another side to that. Another concern with the advantage. Another part of the advantage argument is concerns about proprietary feeds. There's the exchanges have their individual feeds that people can purchase, and then there's the general consolidated tape. And the SEC asked the question as to whether prop feeds somehow gave someone an unfair advantage. Now, I will say that with co-location and prop feeds, what the Division of Trading and Markets did focus on was it said to the exchanges, when you have these arrangements, you have to do a rule filing and you have to make them available on a non-discriminatory matter. So anyone can get them, if they pay reasonable fees and, have the requisite standards. So those are the kinds of concerns. I'd say three: possible manipulation, destabilization, unfair advantages. So how have regulators responded, or how might they respond? What are the tools or categories of responses that might be brought to bear? Well, one, and Chris touched on this, is better information, better auditing and forensic tools. You can let the markets freely develop, let there be innovation, let the technological arms race is not a bad thing, and this technology should always advance. But if something happens, if there's a disturbance or volatility or a possible wrongdoing, have the tools so that you can investigate it. You can get the information. After the flash crash, the SEC took 3 months, which Greg would tell you, to reconstruct the data that it needed. And so one of the things it did was pass a large trader rule, so that the SEC has identified the more than several hundred now. It's probably pushing 1,000. We don't know exactly. Large traders. They get it's called an LTID, and that's appended to their accounts. So when the SEC wants to investigate some trading, they can go to broker dealers and say, we want the trading records of these 4 large traders. So because we need to look at that. So large trader has been adopted, and the next thing on the horizon for an auditing tool is CAT, the Consolidated Audit Trail. And that goes beyond trades. The goal of CAT is to trace the life of an order from entry to either execution or cancellation. So it would really just, it is what it says, Consolidated Audit Trail. There would be a repository. So any regulator who wanted to look into something could go to this repository and just pull out information when it needed it. One of the central themes in the many comment letters that were filed in response to the SEC's proposal on Consolidated Audit Trail was over the issue of real time. The Commission proposed that, basically this audit information be available real time, and commenters said, that's very expensive. And moreover, if you're not really using it for real-time surveillance that will lead to a real-time response, and you're really doing forensics, you want to do them a little better, isn't end of the day enough, isn't next day enough. So I think the SEC is their final adoption, which we would expect in the next couple of months. I think they will adopt. It's a key priority for Chairman Shapiro, and I think she wants 5 votes. And so I think they're moving to a somewhat more workable, perhaps less ambitious, less real-time oriented consolidated audit trail. But that's key. In addition, just plain old getting data and being able to analyze it. And the Commission, I think, has had an RFP for technology that will allow it to better do market reconstruction. So, and quite, depending on how much money the Commission gets, quite a bit will go to technology. Okay, so forensics. What's another category of responses? Well, it's what I'd call either operational capability tools and liquidity guards. And some of these are things like 15C35, the sponsored access rule. That brokers at a certain point started providing their customers with direct market access, DMA or sponsored access. It had a couple of forms, but basically you had to be a member of, for example, the New York Stock Exchange to access that market. So you have a member, an MPID, of an identifying number. And so brokers were providing this number to customers so they could directly access the markets. And what the purpose of the Commission's rule is that when brokers do that, they must make sure that there are regulatory and credit controls so that customers, again, don't blow through with a huge order, don't have the error trade, don't do naked short selling, by not locating shares to borrow. So that's the kind of a tool that you might have. Also, post flash crash, circuit breakers to provide a break when there's a liquidity gap. And the SEC is moving from a circuit breaker, a 5-minute pause, to what's called limit up, limit down, so that you have trades, you prevent trades from executing outside a band, again, in an effort to prevent the kind of gap and crash that we saw in May of 2010. There are a number of reforms that the Commission has instituted post-flash crash, working with the markets in a way to basically prevent that kind of a gap in liquidity. Algo controls, Chris mentioned algorithms. I know that the Commission staff is considering whether to sort of seek to amend 15C35 to require brokers to do some sort of due diligence on their algorithms. I don't think it's envisioned that the Commission would be reviewing the algos, but just basically that if you're providing an automated trading code, you've got to sort of kick the tires, make sure that it doesn't go haywire. That's still very much in kind of the concept stage, but it's talked about. So you've got those controls and liquidity guards. The third category, which is probably the most intrusive from a regulatory point of view, is sort of imposing trading obligations. They can be affirmative obligations. You want to be a market maker, you've got to be have two-sided quotes that are very tight, all the time. Or markets already have such rules. And then negative obligations, meaning things you can't do. If a stock is declining, you can't reach across the market and hit the bids. Those are, I think, more sort of back burner ideas that are kicked around. Those are heavier lifts. Markets already, and TR can talk more about this, markets already provide incentives for market makers to provide liquidity in the form of rebates and reduced fees. So those are really categories of how the Commission has responded and has thought about further responses. So why don't I stop for a while?
Thanks, Jamie. That was great. Theodore, TR is going to be speaking about the overview of market operations and surveillance. And I'm still waiting for someone to distinguish between the good cannibals and the bad cannibals, or good eating of humans and bad eating of humans, as Jamie preferred to put it. But I don't think it's going to come from the New York Stock Exchange. That's my bet. But we'll give it.
There are no cannibals.
There are no cannibals. There we go. Cannibals don't exist. It's just in your imagination, David. Right.
Thanks, Professor Lipton. I want to talk a little bit about the perspective being in NYSE, because we see these developments from two perspectives. One is the operator of markets. So we own the NYSE, which we all know and love, and as well as the old American Stock Exchange and the Market Exchange. So we also see it from the standpoint of a market regulator, because all of the exchanges, as you probably know, are self-regulatory organizations that are obligated to enforce compliance with their member firms of the exchange rules and the federal securities laws. So as I was getting ready for this, I was thinking back to when I started back at the SEC in 1997. Before any of these developments, the exchanges were really the dominant trading venues. At that point, NYSE basically had a virtual monopoly of the market share on trading of its listed securities. Never heard terms like HFT or alternative trading system or dark pools, but there's obviously been a huge change in technology and in regulation since then that have really had an impact of the markets. First was, I'd say, the SEC's adoption of Regulation ETS in 1998, and that regulation expressly allowed smaller trading venues to operate in the manner of a securities exchange, but under a modified regulatory scheme. And it also really represented an SEC encouragement of competition among market centers. So that increase in competition has led to a market structure that we have today in the United States, where trading is dispersed over a variety of exchange and non-exchange market centers. That's something I explain all the time when I say I work at the New York Stock Exchange, and usually friends of my parents tell me that, my trade is being affected on the New York Stock Exchange by those awful program traders, is usually what they say. And I said, well, chances are your trade never got to the New York Stock Exchange, because there are so many venues now that only, it's really dispersed across a number of places. And Chris referred to before the adoption of Regulation NMS back in 2006, and the order protection rule in Reg NMS really did create a regulatory preference for automated over manual trading by providing that only automated quotes get trade through protection. So, like all market centers, NYSE has embraced the use of technology. We've made two significant changes to the trading model of NYSE since the adoption of NMS. Not too long after NMS was adopted, NYSE merged with Archipelago, which has always been an all-electronic exchange. However, we still maintain an active trading floor that includes floor brokers who engage in, I think, Chris, you made a good point. Everything's by computer, but there is, some manual trading that involves human beings on a floor putting, trades into a computer. It's not a lot, but
Twice a day.
A few times in between.
Yeah.
And when the circuit breakers go over.
Right.
But we still find that there are market participants who want a manual trading alternative or a floor trading alternative to complement electronic trading. And it was interesting. There was some discussion about concern with unfair advantages, and we find ourselves in a continuous dialogue with the SEC, despite the fact that it's a relatively small portion of trading, a continuous dialogue about supposed informational advantages to people on the floor that I can't tell you how much time of my day is spent trying to explain that no, there's not a secret market going on the floor of the New York Stock Exchange, and I think that we'd have better market share if there was. So, and we've talked a lot about the flash crash, and that really highlighted a lot of these issues for the public and for the press and for regulators. The dispersal and fragmentation of the markets combined with the emphasis on speed of execution all kind of came to a head that day. And our other perspective on this is as a market regulator. We
NYSE no longer do our own market surveillance. We hired FINRA, which you've probably all heard of, about 2 years ago to do that for us. We still oversight FINRA's performance, but FINRA does the day-to-day surveillance, and we rely on them to have the tools necessary to keep up with technological advances. We talked a little bit about changes in regulation to look at activity, but we also at NYSE are very focused on regulation, the structure of regulation, that with today's market structure, it doesn't make as much sense to have regulation be on a market-by-market basis. And so one of the main drivers of us going to FINRA was to implement cross-market surveillance. And we were talking about reconstructing data. I feel like I spent the entire summer of 2010 responding to SEC data requests after the flash crash because there was no one place that had all the data, and so the SEC was going out to all the exchanges and market centers and pulling data and putting it together, and each exchange has a different format, and it was, I can only imagine how much work it was at the SEC to pull all that together. So we're very supportive of the kind of thing that the consolidated audit trail would bring. Jamie brought up the costs. I think that we're concerned about the costs and the need to do it real time, but we hope that that's one step towards having a fully integrated cross-market surveillance mechanism in the United States for security surveillance. So that's what I have to say. That's my perspective here.
Okay, well, listen, that's a start. I want to open this up to the audience. There are a number of alum. There's a crowd here from FINRA who are secretly dispersed about the audience, and they also are trained by Al Qaeda, and so if you do the wrong thing, but let me.
They're going to be asking for copies of your code.
Yeah.
The next section of my talk is about how wonderful FINRA is.
Let me try this out so that maybe some people in the audience get a greater sense of the 800-pound gorilla that's being hidden from you. When Jamie spoke of co-location, and those of you who've been in my class know this, what we're saying is that there are traders who are willing to spend a whole lot of money to have a little box placed next to a trading platform. So out in Saddlebrook, New Jersey, they will rent space so they can have this little box there, because if they send their execution order from Saddlebrook or wherever, that'll be right next to the trading center, like 40 yards away or something like that. It'll get there in, let's say, 2 nanoseconds. And if you sent the same order from the center of Manhattan, which is where they really are located, it would get there in maybe 8 nanoseconds. And they're willing to pay this extra money, co-location, to be that close. That's thought number one.
7 milliseconds, but
Oh, okay.
from Manhattan.
I'm just giving rough figures. That's thought number one. Thought number two is that, and again, the figure that was used, which went back to 2010, 29, was that about 50% of our trading is done through this program mechanism. There are figures that speculate that, substantially more, maybe up to 70%. Thought number three. I'm going to tie this together, believe it or not, maybe. Thought number three is we spent a lot of effort, a lot of thought, a lot of policy, a lot of, gazillions of dollars for companies to develop these disclosure information, all of which is based upon the theory that we could perhaps identify the underlying value of an instrument that's being traded. And these algorithmic computers ain't reading that stuff. And if they did read it, it wouldn't mean diddly squat to them. So we have a highly developed, sophisticated informational disclosure system that goes to the underlying value of the instrument. We got 50 to 70% of our trading that it has absolutely nothing to do with this, except perhaps within the parameters set by this disclosure. We have people paying loads of money. Chris can tell us exactly how much. To be 40 yards away from a trading platform as opposed to 10 miles away, and that makes a difference. And what's a mother to do? I'm an investor, and once upon a time we thought it was neat for citizens to be invested in American securities. I'm an investor. I know I don't have co-location, and okay, Jamie says, but you don't really care about that slight little difference. That's true, but I do care about Apple going down 10% in a day and being on the wrong side of that. And what is this disclosure information doing for us? What else might I want to know? And again, Jamie, you spoke, I think it is Rule 13, H6, I think the large trader disclosure. We put in place something saying, okay, if you're a large trader, report it. But I'd like to know in anyone's security how much of this security is being done by program trading, the real program trading, not the program trading that your mother and father also do because they own mutual funds. And does that make a difference? Do we need a new disclosure system? So here's my final question to all of you. Has this development changed the needs of our disclosure system? Is our disclosure system now antiquated? Is the individual investor now really having no ability to compete with Virtu or anyone else? And is the movement toward a totally programmatic trading system something that is going to enhance the confidence in our capital markets? Yes, it adds tightness, it adds liquidity and depth, but does it lead to the confidence of Jane and Joe investor? And then we'll open it up to the audience. I don't know. I'm not going to pick on one of you. It's probably
you want to
Chris.
lead?
Yeah, I'll jump on that.
Well,
I think we have to look at interesting points. I've never heard anyone raise our disclosure system in the U.S. as being impacted by high frequency trading, but you just have, so I'm interested. Look, I think you have to, in just the context of disclosure, the disclosure system that we built in the U.S. is a reason why we have one of the most vibrant equity markets around the globe. People get fair access to information in real time, all the time. And there's a reason why we have some of the highest investor participation rates around the globe. We have some of the most efficient markets around the globe. And that is just pure statistics. You can look at the exchanges around the globe, take a large London traded stock or a large Hong Kong traded stock and place it on the New York Stock Exchange, and you get wildly different market efficiencies and investor participation. So we clearly have created something that is superior than other markets by having a lot of automation, a lot of efficiency been delivered to the market. I don't think the disclosure system should be changed or has little relevance anymore, just because there's a series of intermediaries that are ignoring the relative value of the stock at any moment in time. If you go back in time, in the 90s, the specialist really didn't care what the stock did. He tried not to have a position in it. So he would enter the market and try to be flat as often as possible at the end of the day. He didn't care if the stock went up or if it went down. He was just trying to make a spread. And traditionally, dealers have always just tried to make the spread, that they buy on the bid and they hope they sell on the offer. And years ago, that spread was monstrous. It was more than the average brokerage execution cost. So your cost of entering into an investment was actually relatively expensive. It was more than what you paid your broker. Nowadays, it's the effective spread in the U.S. is less than a penny. We can only quote in pennies, but the effective spread has collapsed below that. So if you want to be an intermediary in this market as a profitable enterprise, you better do more than just trade a stock. You actually have to trade a lot of stocks. And you have to trade more than just U.S. equities. You have to trade around the globe in order to make a business out of being an intermediary. I'll give you a perfect example of what we do. We trade Microsoft every day as a dealer. We're a market maker on a variety of markets. We trade anywhere every day from 10 to 15% of Microsoft. And every day we make maybe $200 to $300 trading 10 to 15% of Microsoft. That's after all our fees, all our costs, before applying fixed costs. That's our trade P&L. So the ability to make money as a market maker in the stock reflects the true efficiency of the stock. The investor entering to buy on a bid is actually not crossing a wide spread. Their cost of entry is much lower than it has, and much lower than most other assets that they may actually trade. And so in order to thrive on $200 to $300 a day, you can't do it with a human trader. You have to have an automated application sitting somewhere to do that. And you have to have the efficiency to allow that type of activity and still make $200 to $300 a day. And so that's really what we do, is we do that. We do Microsoft, GE, Ford, you name it. We don't know what those stocks are going to do any given day. We don't follow the investment pattern of the stock. We know if there's news because we likely lost money, but we don't know or care whether it's a good investment or a bad investment. And we do that for over 1,000 names in the U.S. We trade in Canada, Mexico, South America, Europe, Asia, you name a market, we're on it, trading it. In the U.S. alone, we trade on 30 markets. So there are only 13 exchanges, but we have to access 30 markets in the U.S. to trade Microsoft. And you see the fragmentation that we've created because of many of these years of SEC rules have created a very efficient market. We have some of the most efficient pricing mechanism for assets that you can find around the globe, but it's 30 different markets. There's actually more than 30. We just don't want to connect to the rest of them. And so you see the magnitude of trying to be a professional dealer in a market and how difficult it is and how automated you have to be. So when we look at our business and we look at the fractions that we make, we say, well, we have to be high frequency to trade as a professional, as a dealer in the market. Now, David, you mentioned co-location and the issues around co-location, and I, there are issues around co-location. So co-location is, the exchange sits in a data center and everybody crowds around. So it's the old-fashioned crowd around the specialists, just computers sitting around an exchange. And you do have people, I ran co-location at NASDAQ, and you have people calling you and asking you if they could put their cage closer. Now, a cage on this side of the data center versus right next to the actual matching engine, the computer that the exchange runs, it's nearly 2 nanoseconds difference. That's not material when you're trading a stock frequently and there's variables and switches. But people would actually ask, can I be on that left side of the data center or the right side of the data center? And we'd say no. Nowadays, everybody has what they call the equal cable length. So regardless of where you sit in the data center, the exchanges coil up cable so everyone sits an equal distance from the actual matching engine. The problem with the U.S., though, is there's 13 markets, exchanges, and there's 30 markets, probably 50 markets in total. Where the hell do you co-locate? You got to make a co-location decision. There's Carteret
is NASDAQ. That's down on, it's all along, by the way, 95. So all U.S. equity trading is done in Jersey. There's no trading in New York. We try not to tell the governors of New Jersey because they'll clearly tax it. But it's all in New Jersey. So when you execute a trade somewhere on a web browser, it's going to Jersey. And I think that's the true scandal that we should actually focus on. But no, so you have New York Stock Exchange is in northern Jersey. They have a place called Mahwah. You have exchanges like that's in near Jersey City, in Secaucus, and you have various dark pools all over the place. So you literally, co-location may advantage you one day in one symbol in NASDAQ's data center, but you're disadvantaged in New York's data center. And so to me, it's a lot of discussion around a lot more complexity than people realize. As long as it's fair, if you want to co-locate because you want to trade a lot, it should be open to you, and you should be allowed to access it and gain access to co-location. That's kind of my biggest issue with co-location is as long as it's available to everyone and not restricted. If you go back to the New York Stock Exchange, and I'm sorry to pick on New York, but NASDAQ had its own issues. But in the old days, there was a specialist, right? Those specialist rights were passed down in time through families, through history. They were a privileged right, and you couldn't get it. I couldn't get it. No one could buy it. It was Goldman Sachs paid somewhere like $4 billion to buy Spear Leeds just to get a specialist position. So they're very privileged membership rights. That's gone, right? We have what's called open access. Your order from your website on TD Ameritrade is going to be posted right next to the specialist quote with the same rights, the same speed. Unfortunately, you're hitting a web browser and he's got a computer in a data center. But you have the same access that a specialist had 10 years ago with the same privileges. And that's exceptional, and that's really what made the market what it is today, how vibrant it is today. So it's really fair access, and everybody's right. If you want to, I look at it this way. I think it's unfair that some hedge funds have great research, right? I want to have good research and make good investment decisions, but they buy the best research. And should we say, geez, that's not fair. We should make research available to everybody that they buy, and that's just not how the market works. And it's similar to trading. If you want to make a profession out of trading stocks, and if you want to make $200 a day trading Microsoft, and you think that's a good business, buy some colo, buy some prop data, and have at it. And you can do that technically. No one's stopping anyone from doing that. So it's more about fair access to these things that we're partaking in, and how we do it as a dealer and an intermediary. But to David, your point about 60% and how does it work? The market has always been that way. Intermediaries, if you go back into the 90s, the dealers in NASDAQ made up 60 to 70% of every trade they were on the other side of. So it hasn't moved that much. There's ETFs that we are the sole market maker in, and we can be 80% of the market because we're on every trade. Every trade that comes in, they're hitting a bid or an offer, and we're the only one sitting there. So intermediaries historically have made up large portions of the market and have cared zero about the investment decision of the product they're trading.
Okay, you buy that? I got a bridge I want. No. Listen, I want to open it up, unless Jamie, I'm sorry.
Well, I just wanted to jump in for a second because I think that, Chris, just to answer your question, I think disclosure still matters because companies do still trade on fundamentals. I mean, if a new Apple product is well received, Apple stock goes up. That still exists. So we still need that. And in fact, having worked many years at the SEC, every week there was an enforcement meeting, and there were probably 5, 6, 7, 8 penny stock frauds that were conducted every week. And the problem there was people fraudulently selling garbage. and people, investors lost a lot of money, individual investors. So, that's way bigger a risk, I think, than, millipennies that conceivably could be lost from HFT. But what the world does suggest is, a lot of what the Commission's focusing on is, again, mentioning Apple, if there's a glitch that tanks Apple stock, that shows why we need to focus on operational capability. As Chris suggested, where trading has moved to automated systems, then you need regulation to focus more on that those systems work well. The SEC staff has been very aggressive, as TR will know, on markets, making sure their systems are working well, and I believe that will be extended to firms, and I think 15C35 is the nose under the tent in terms of operational capability. We see issues with cybersecurity, with privacy, so better audit information, so when something does go wrong, regulators can discern the problem and fix it. So large trader, consolidated audit trail, those are the things the Commission, I think, needs to do. We should be reminded that during the financial meltdown of 2008, the equity markets worked very well. They were orderly. We were brought to the financial brink because of sales of bad mortgages and resales of securities based on bad mortgages, not because of high-frequency equity trading. So, I think that's where the focus has to lie. And along the lines of where it should be regulated, another thing the Commission's looking at is whether, if you are a significant trader, you should have to register. So again, you can be brought under that sort of regulatory and exam umbrella. If you're a broker-dealer, if you're a significant advisor, you have to register. So that's one other area of possible regulation. Anyway.
Thank you. And by the way, George, you, with that $200 to $300 a day profit loss on Microsoft, you could take Chris off of the solicitation list for the Security Scholarship Fund, but it doesn't matter. It isn't important. Let me open it up to some of the people in the audience. I know there's former FINRA, there's current FINRA folks. There's John here who's got some interest in high-frequency trading. Questions from you people? Pat?
Do you see any of the SEC's regulation restricting the ability of high-frequency traders to be market makers and create liquidity, or will it be more of like you have to register just so they can kind of keep tabs on you?
I think that there would be a heavy lift. Dealing with obligations would be the sort of most intrusive level of regulation. I think the focus is going to be on better audit trails and operational capability. I think it'd be very hard to get a political consensus to do more. Now, again, markets offer incentives for market makers and so forth, but no, I don't see a restriction on the ability to trade.
Yeah, just to add to that, I think I agree with the SEC. It's one of their challenges, and they have to come to an expert like Professor Lipton on broker-dealer registration. Right? At some point, when you trade, my firm could sit in an unregulated vehicle and trade, 15% of Microsoft, and I just think that's not appropriate. At some point, we've triggered registration in the U.S., and we should be subject to the jurisdiction of the SEC and regulators directly, not indirectly. And I experienced that exact feeling when, when I was at NASDAQ, there was a hedge fund that had a co-location box sitting in the data center, and they were trading as Morgan Stanley. And I knew them because they would talk to me, and they would talk about their box, and they traded a significant portion of stocks on NASDAQ, just like a dealer. And you say to yourself, God, this is a London-based hedge fund that is trading directly on the exchange under someone's name, and we have no jurisdiction over them. That's truly insane. And if you look at the broker-dealer registration, and it's really a laundry list of letters over the years that the SEC has issued that defines what a broker-dealer really is. it typically involves a customer. And once you touch a customer in the capacity of transaction of securities, you're going to be a broker-dealer. It doesn't ever contemplate someone that trades so much and in a certain manner should be a broker-dealer. And ironically, in Europe, some of the rules in Europe define market makers as triggering registration. So if you behave as a market maker in Europe, you trigger registration in some jurisdictions. And so people are very careful of that. In the U.S., I can look and feel and do everything that a market maker does. As long as I don't touch a customer, I don't need to register. And I think that's a fundamental flaw in our securities rules. And I think people that reach certain sizes, and I think large trader kind of gets there, right? It says, okay, let's find out who the large traders are, and then let's understand them, and then maybe we have to force registration. And then once you register them, you've got them under your jurisdiction, and you can start making sure they're doing, they have appropriate procedures and doing all these things. So I think that's the right direction to go in. But unfortunately, the long history, and Professor Lipton knows his history of broker-dealer registration, always involves the client and the customer and that issue. So
that's a good point. One of you had mentioned the SEC looking at the algorithms. I'm not quite sure to what end, but whatever end it is, other than Greg Berman, is anyone equipped at the SEC to look at algorithms?
Well, no, and I don't think I think what the SEC would do is require firms to have policies and procedures to do some kind of diligence and check on their algorithms. The SEC wouldn't actually be looking at them. No, I agree. And there is a need for greater expertise, in trading and technology.
John?
Putting aside regulation for a while, is there any activity that you see in the high-frequency trading now that, if you chose, that you would take to the enforcement division and say, this is wrongful conduct, this is violative of the federal securities laws, and should be investigated and prosecuted?
Yeah, I've seen it when we've done that. So we turn over fairly regularly what we see is kind of inappropriate behavior. A perfect example, and we saw it probably about a year ago, was some people call some flickering, like quotes flicker. Well, this was a systematic. Every 500 microseconds, this quote would pop up and disappear systematically. And what they were doing is they were trying to game the computers that were actually trading the stock. So our computers were getting gamed. Probably other dealers were getting gamed as well. And so it was a systematic computer-generated flickering. And we had it timed, and we knew that they would pick the size of their orders randomly to avoid surveillance mechanisms that looked for flickering. And we saw it first in ETFs, and then it made its way into the futures market. Saw it in the E-minis, and turned it over to both FINRA and the regulators at the CME.
And that's where you get
conduct other than flickering?
It's hard. I mean, I kind of feel like we're a bit of a canary in the coal mine because we're on all these stocks and we're trading quite actively and quoting actively, and so people with bad intent could manipulate us. And really, the only things we've seen are kind of that behavior. We haven't really seen the other strategy. There's a famous case called Trillium, where one participant was placing large side orders below the best price. And on the other side, the trader, it was actually a computer, was seeing that large side and making a change to its markets that this trader then took advantage of. Ironically, the Trillium case, which has been touted as a HFT case, it was the HFT who was the guy being gamed. It was actually a manual trader gaming him. And the reason why I know that is they came to me when I was at NASDAQ to complain about the behavior. I knew both parties. And my first reaction was like, you guys really need to change your code if it's being gamed. But that was turned over and a case formed against this human-based trader manipulating a computer-based trader. We haven't seen, there's this other notion of what people call quote stuffing. It sounds pretty interesting, sounds neat, and the theory is that someone sends so many messages to a market, they stop everyone from trading and they take advantage somewhere, somehow, and we've never seen that. And in fact, we don't even know how that would play out because we know our capacity to send messages, and the sheer act of over-messaging a market actually makes it hard for us to trade. And in fact, we have all kinds of messaging governors on our system because we can't trade if we've over-messaged the market, when we can't even get orders out of our system because it has its own limited throughput. So this quote stuffing notion, we keep hearing about it, but we haven't seen it. The problem is it can be mixed up with when there's news. Anytime there's news on the market, the Fed announces something, employment comes out, the markets technically get stuffed, right? Orders come in from everywhere, and they overrun markets. The 13 markets and all the dark pools slow down. And I can rattle off the ones that go down first because we know, I won't name the firms, but as soon as there's news, they start to jitter, they get slow, and it's not someone quote stuffing, it's literally the market stuffing itself in a reaction. But that's all we've seen.
The flickering, I assume, is being sent out to try to find interest and price interest in particular instruments.
Yeah, what it's trying to do is, if you have a computer that wants to be on the best bid and the best offer all the time, and someone flickers, you'll follow the flicker because you're reading that 500 microsecond quote feed, and your dealer strategy will actually join that bid or that offer, and then they'll pick you off from the other side. And that's we would lose money, and you'd go in and you'd look and you'd see this, and you'd have. So we then wrote anti-gaming code, and that's deployed around the globe in every market we trade in.
Anyone else in the audience? Oh, Luke, yeah.
So to distinguish from the 2008 crash, which was caused by selling bad mortgages, what would be the worst case scenario that we're trying to prevent by regulating high-frequency trading?
I think the flash crash is an example of, it's not just high-frequency trading, it's computer-based trading.
Sure.
A computer can run rampant on our markets and create havoc. I mean, in Tokyo, you had an example where you had just an erroneous trade that almost brought down a large bank because the Tokyo Stock Exchange didn't know what to do when the bank said, oh, I didn't mean to do that. Well, you traded billions of dollars of stock through this computer-generated order. You now own that at a loss. And so really it's the sheer power of a computer and what it can do to our market to disrupt it. And that's an issue. Whether it's in the hands of a retail investor that just turns on something by accident, or it's in a professional's hands, or it's in an institutional investor's hands. It doesn't matter. It's that computer power that can disrupt our market.
Sure, but I think my question is regarding like the end result. So like with the flash crash or with the bank in Tokyo that almost got in trouble. In both cases, wasn't the problem resolved with virtually no consequence to anybody?
No, the problem is if you're an investor watching the market fall apart. I mean, so the flash crash literally probably cost the market a substantial amount of capital growth because the investors watched it and thought, I can't trade in an environment that is not stable.
Well, I personally spoke to some of the leading Silicon Valley IPO lawyers and and they were saying that people were reluctant to price, reluctant to go public because they were lacking market confidence, and that's a bad thing. Also, in flash crash, there were people whose trades got executed at absurd prices. Now, a lot of them were broken, but there was a price level at which people lost a significant chunk of money and didn't get broken. So, so there was some loss.
Even the ones that stood, a lot of them were just had nothing to do with the market. I mean, it was just you had to you
Right.
decided, okay,
So-
we're going to break everything that's such and such away from the market, but there were still a lot of people who got really bad executions that
Yeah.
day.
And you could have a cumulative effect if you have enough glitches that get headlines and they're significant. What you could have is a continued, diminution of market confidence, which would not be good.
Right, so wouldn't the best solution be to put in more anti-gaming code or have a faster circuit breaker?
So the circuit breaker is really,
And limit
the
down.
SEC concluded that
Yeah.
a circuit breaker needed to be put in instantly. And in fact, just the other day, Apple, that bad trade that went off on Friday, it actually hit the Apple circuit breaker that was put in by the commission in response to flash crash, and Apple was halted. And, obviously that freaked a lot of people out. Why is Apple halted? And so it's that disruption that people want to avoid. But the new rules that Jamie was mentioning, it puts an obligation on the broker to not let these bad orders come into the market. So if you have a runaway algo, you're now on the hook to stop it. And so that's really where we're getting to, is protect the markets before these things enter the market, and put the obligation on the broker to not, that broker giving a hedge fund his connections and letting the hedge fund do whatever he wants, that doesn't exist anymore. That's been outlawed, and now the broker has to check everything passing through its pipes. And that's how it should be.
Okay, thank you.
Listen,
In the flickering quote scenario, for instance, how do you program an anti-gaming software to evaluate whether or not that quote's bona fide?
The irony is, a timer. You basically say, I will ignore all quotes unless they lasted for X period of time. And each asset class that we have it in, you adjust that timer. In futures, we trade energy futures, and that timer is much longer in energy. In Asia, it's much like the U.S., so it's a much shorter time period. So you just ignore it. You pretend it didn't happen until it's there long enough.
What does that do for the trader who actually is using that to indicate, as an indication of interest or trying to gauge interest on that?
We're talking, what does that do for the folks that are quoting and not being there long?
The actual person entering the quote.
Well, he probably should be there a little longer than, we're talking microseconds timers. So this was 500 microseconds. We're now up to like a millisecond, and we'll follow a millisecond. If you're there shorter than a millisecond, then I'm not going to chase you. Figured that was appropriate. But so you're talking micros and milliseconds in a world of where most people think of as seconds. But if you think of the average exchange, you submit an order and a quote comes out. The average exchange, a BATS, a NASDAQ, it's 250 microseconds that happens. And if you think of an average quote, there in some active stocks, there's close to 1,000 updates in a single second. And it's mostly size updates, but 1,000 a second. So you can see the level of activity that our market has achieved.
Some of the proposed solutions have been either an order fee, order tax, requiring orders to be alive for a limited amount of time.
Yeah, minimum quote life, yeah.
What's your view on that?
The problem with minimum quote life, and we trade in a number of markets, like the FX market has a minimum quote life in some of the markets. The folks with more sophistication will decide and program in the life of every order that comes into the market. And so there'll be a timer. And so that order, subject to the minimum quote life, is always going to be negatively selected at the end of his life. So it's an option, right? A quote today is a free option. You're saying, I'm willing to price this asset at this price, and I'm showing everybody, and it's live, and you can execute it. If you make that last longer, I'm always going to be selected when that option is no longer in my favor. So what you do is you widen out the spread. So everyone subject to minimum quote widens out their spread because of that option value that you're handing the market. And you can see it in the FX market, the spread widens on the EBS platform where there's minimum quote life, and in other, like CurrentX, there's no minimum quote life. It's slightly tighter. So the end result can sometimes not be what you wanted.
We actually pretty much hit TR's schedule. There is a reception out there. You're all invited. I want to thank this panel. Just excellent. Just what the doctor ordered. I wish we, well, we do have it on tape, so we'll be able to review it. Chris, thanks for coming down from New York. Jamie, thanks for coming over. TR, thanks for pulling this together
Oh, you're very welcome.
and being here. Lovely job. Thank you.